Hey guys, welcome back to the channel. Today's video we're going to be looking at the Federal Reserve and the recession that could or could not be coming, guys. Now overall, it is likely that the Feds are saying they are not going to cut interest rates in 2023. In addition, there could be an interest rate increase coming in June. There is right now a 76% probability that we are going to see a 0.25% increase in June, because the inflation rates are not falling as fast as they're looking at, but the markets do not buy it, guys. If you have checked out the S&P 500, that ETF that I always talk about, it has been performing incredibly well, and the stock market has been doing the same throughout this. That is why, again, a lot of people are saying it doesn't seem like the market and a lot of the forecasters and a lot of the economists are saying that we are looking at a recession, that it might completely be canceled to some extent. If the US slips into a recession in the second half of the year, as most forecasters still kind of expected to, the Federal Reserve says they will be doling out tough love instead of a lifeline for people who are very responsive to the economy. So of course, if we see rates increase, guys, that means the cost of goods are going to go up and things are going to continue to get more expensive, even more expensive than they have been. So there's a good chance the Fed will pause interest rate hikes, which again, this is another sign that one, we have kind of hit the point. Now we need to essentially wait a couple months to see what the inflation numbers do if they start coming down, because remember, the impact of the rate hikes actually takes several months after the rate hike has been put in place. And we have seen more rate hikes in a shorter duration than we ever have in history. That is right, guys. In history, we have never seen rates go up as fast as you've seen them. But also, in real life scenarios, we have actually seen some of the longer term rates on saving tools and also CDs actually come down. 3, 4, 5-year CDs have started to decline, which again is kind of an indicator. You know, a lot of things look at the 10-year treasury bond, a lot of things look at the 30-year mortgages, which we've seen them actually increase within the past week. So how much did the Feds actually raise the interest rates? That is right, guys. The Feds raised it by 0.25% earlier this month, capping at 5.25%, an increase of 5%, a little over 5% now, guys, within 14 months. It is the most aggressive campaign in 4 decades. So going back 40 years, we have not seen this many rate increases. But to remember, we have not seen rate increases going up this fast in this short of a duration. Now, economists have also said there is about a 9-month lag to rate adjustments. So when you think about that, guys, in 14 months, we have done an incredible amount of rate adjustments. And they say there's roughly a 9-month lag to the impact that we have in the economy. So again, how does raising rates help the economy? Now, this again is kind of a little bit of a lesson. If you take an economy classes, if you take any finance classes, things like that, it is the Federal Reserve's job. Now, remember, the Fed is not a government entity. The Federal Reserve is a private organization. And this is where, you know, when you've seen Jerome Powell and when you've seen Donald Trump, you know, our president, our former president of the United States, kind of at wit's end or at odds, because again, they wanted to control things that are 2 different companies that are really trying to manage and control 2 different things. Now, the most critical step of the Federal Reserve is, of course, to fight inflation so we don't become entrenched like we did in the 70s and actually see no growth or see zero growth, negative growth in the economy itself. Higher interest rates make it more expensive for consumers and businesses to borrow, dampening spending, prolonging companies to hold prices steady or lift up prices. And also, a lot of companies, if you've watched the news, if you've watched some of the media, budget a lot of the books with laying off individuals. We have seen companies like Meta, we have seen Google, we have seen, just an absolute crazy amount of companies that are losing 1,000, 5,000, 10,000, 20,000 people at a time. This is to offset the books, offset the costs that they're incurring because of the more expensive things that they have. Now, to a larger extent, the Fed strategy is rooted not just in action, but in a promise to raise rates, keep them elevated until inflation comes down. Now, if workers believe that prices will continue to climb, they're more likely to demand pay raises, and the cost of business will be offset by the nudging prices. So now you have a workforce that is demanding higher pay raises and higher pay with a more expensive operating expense for businesses because things are more expensive. It's a very, very slippery slope between all of those. So will the Fed reduce interest rates, guys? This is what we're talking about, and this is what we have kind of been focused on. When the Feds do start to actually lower interest rates, we are going to see the market, in my opinion, again, not a financial advisor, but most of the financial advisor friends that I have and people I talk to, if the Feds do trim rates, it is possible that we are going to see a very, very sharp climb in the market, because as soon as the Fed starts raising rates, remember, all of the money that went out of the stock market, that went to a lot of different vehicles, whether it was bonds, whether it was moving into bank CDs, whether it was going, into alternate kind of investing things, was pulled out of the stock market at a point, causing it to really dip, which was 2022. But now we will start seeing, as rates decline and the CDs are not as attractive, people will start bringing money back into the stock market, including larger organizations, larger businesses that do invest in the stock market itself. Again, a lot of people right now are kind of sitting cash heavy, which I have advised people to do, just sitting on a little bit just in case with that emergency fund, just because of what is everything is kind of going on in the market today and really getting it adjusted. Now, again, a lot of people are saying the Fed will not cut the interest rates this year. That is yet to be seen, guys, exactly what they're thinking. I'm kind of on the fence with both. I feel like if we hold steady for a couple, let's say the next 6 to 8 months, we could see inflation come down significantly to a level that is acceptable for the Fed. Because remember, the Fed's target is 2%, guys. That is what they are trying to get inflation down to, is that 2% goal. But it's going to be interesting to see exactly where the numbers continue to come in, because we know the jobs report is still coming in very, very strong. People still need people to work. And this is really big picture thinking, guys. When you look at companies, even locally where I'm at, everybody is hiring, guys. We have from Walmart to Menards to Kroger, to BJ's to Sam's Club. Literally every organization that you have around where I'm at, just north of Detroit, is currently hiring individuals and looking for work. Even though a lot of other companies are letting people go, there is still a very, very high demand for workers. So guys, that'll do it for today's video, but let me know in the comments what you guys think. What is your prediction for what the economy is going to do within the next few months? Are we going to see another rate increase in June? Are we going to see some dips or some declines coming in November and December? Time will tell, guys, but continue to budget, continue to stick with your financial plan and look at the goals that you do have and how you're going to achieve them. So again, that'll do it for today's video. Let me know in the comments what you guys think, and as always, thank you guys for watching.